Most people think growing wealth is about picking the right stock, timing dips, or jumping onto whatever hype Twitter is screaming about this week. The reality is, those strategies fail for the average investor more than 90% of the time. That's exactly why ETFs were created, to fix the mistakes almost everyone keeps repeating. And when you see how brutally simple they actually are, you'll realize you've probably been slowing down your own wealth without even knowing it. Reason number one, ETFs beat almost every other investing method is instant diversification. Unless you have thousands of dollars lying around, you simply can't build a properly diversified portfolio on your own. Buying individual stocks one by one is slow, expensive, and stupidly risky, because if one stock tanks, your entire portfolio gets punched in the face. ETFs eliminate that risk immediately. You buy one ETF and instantly you own hundreds, sometimes thousands, of companies across different sectors, industries, and even countries. This drastically lowers your risk because one company failing can't take down your money, and it gives you access to assets you'd never be able to buy individually, like entire indexes, global markets, bonds, and even real estate, all in one click. That level of diversification would cost you tens of thousands to recreate manually, yet an ETF gives you that same protection for the price of a single share. This is the foundation of why ETFs grow wealth faster. You stop losing money to stupid, avoidable mistakes. Reason number two, ETFs grow wealth faster is that they don't bleed you dry with fees. Most people have no idea how expensive their investing actually is. Mutual funds, managed portfolios, and robo-advisors love to brag about performance, but they hide the fact that they're quietly charging fees that compound against you every single year. A 1 to 2% annual fee doesn't sound like much, but over 30 years it can cost the average investor tens of thousands, sometimes even six figures. ETFs flip that entire script. Most ETFs charge fees in the range of 0.03% to 0.20%, basically pennies. That means more of your money stays invested, more of your gains actually belong to you, and your compounding accelerates instead of being slowed down by hidden costs. Here's a simple example. If two investors both put in $300 a month for 30 years, but one pays a 1% fee, and the other uses a low-fee ETF, the ETF investor can end up with more than $70,000 extra, and they didn't take any extra risk. They just stopped letting fees eat their future. The takeaway is simple. ETF investors grow wealth faster because they lose less in fees, and that difference compounds massively over time. Reason number three, and the one that blows most people's minds, is compound growth acceleration. Compound growth is money earning money, and then that money earning more money. Sounds simple, right? But most people underestimate how fast this snowballs. ETFs supercharge compounding in three ways. First, automatic dividend reinvestment, or DRIP. Every time the companies in your ETF pay dividends, those dividends are immediately reinvested, which is money working for you without lifting a finger. Second, consistency. Because ETFs track indexes, you don't spend time second-guessing or missing opportunities. You're always invested in the market, and every quarter your gains feed into more gains. Third, low fees combined with broad diversification. When you mix these, your compounding isn't eaten alive by fees or big losses. It just grows steadily, faster than most active investors ever realize. Here's a quick real-world example. $500 per month into a broad market ETF for 20 years could result in mid-six figures or more. The same money in individual stock picks is high risk, inconsistent, and often produces lower return. The twist? Most investors focus on trying to beat the market, when the fastest path to wealth is letting the market beat the average investor for you consistently for decades. This is the secret weapon most people never consider, and why ETFs can truly fast-track your financial freedom. Now, I know what you're thinking, but what about picking stocks myself? Or, ETFs sound boring, isn't active investing better? Here's the harsh truth. Most retail investors underperform the market. Statistically, the average stock picker loses to the S&P 500 over the long term. ETFs aren't boring. They're efficient machines for building wealth quietly, without emotion wrecking your decisions. Let's be real. The thrill of hitting a hot stock might feel good, but your portfolio doesn't care about hype. It cares about consistency. And here's the kicker. Steady, automated growth compounds faster than chaotic, high-risk gambling ever will. ETFs work not because you're smart, they work because they remove your ability to do dumb things. Let's get one thing straight. ETFs aren't a get-rich-quick hack. They won't double your money in a month. They won't make you famous on TikTok. They won't give you instant gratification. But here's the thing most people miss. Over time, ETFs consistently outperform 90% of active investors. They do the boring work you're not disciplined enough to do yourself, quietly, automatically, and efficiently. The reality check is this. If you can stick with them, your portfolio grows far faster than most people realize without the emotional roller coaster of stock picking or market timing. Here's a simple ETF plan you can start today. Pick low-fee, broad market ETFs, like an S&P 500 ETF, a total market ETF, or a global index ETF. Automate your contributions. Even $100 to $500 per month adds up over time. Turn on dividend reinvestment so your gains buy more shares automatically, and ignore the noise. Don't try to time the market or chase hot stocks. The magic happens when you show up consistently and let compounding do the heavy lifting. Automate everything. Emotion kills more portfolios than recessions ever could. If you thought ETFs were powerful, wait until you see how a single contribution hack can speed up your wealth growth by years. And if you want more actionable finance strategies that actually build real wealth, make sure you subscribe and hit the bell. No hype, just results.